Okay, I see folks are still trickling in, but let's go ahead and get started since this is straight up on the hour. Thank you for joining our webinar today. Everything old is new again, commercial paper market and regulatory developments. My name is Jason Elder, and I'm a capital markets partner at Mayer Brown based in the New York office. It's my pleasure to introduce our panelists. Stuart Cutler. Stuart joined Barclays Capital in August 2010 as the head of money market origination. Prior to joining Barclays, Stuart was head of money market origination at RBC Capital and at Merrill Lynch, where he specialized in asset-backed commercial paper and medium-term notes. He also served as the head of origination for asset-backed commercial paper at Lehman Brothers. Our next panelist is Ian Rasmussen, is the managing director and co-head of North America Asset-Backed Securities Ratings. Ian's primary responsibility is leading the team covering unsecured consumer assets, including credit cards, student loans, and personal installment loans. Ian also leads teams assigning ratings in asset-backed commercial paper and credit-linked notes. Previously, Ian was a member of investor development responsible for investor and banker relationships, focusing on commercial paper, money markets, and cash management. He also has experience rating money market funds, local government investment pools, closed-end funds, and conducting CLO manager risk reviews. And last but not least, Jerry Marlott, a partner of mine, is a capital markets partner in the New York office with a focus on term debt, capital instruments, and covered bonds for Canadian banks and commercial paper programs and ABCP conduits. Before we get started, just a few housekeeping matters. We're offering CLE credit to those seeking it for today's session, and we'll read the CLE code aloud when it appears throughout the presentation. The CLE forms have been circulated along with the connection details for this section, and they should be completed and returned to the Mayer Brown email address listed on the documents. Should you have any questions throughout the presentation, feel free to enter them into our chat box, and we'll do our best to answer. Finally, please note that we will circulate a copy of the materials and a replay of this session in the coming days. So thank you again to our panelists and to our audience for joining. And now I'd like to turn the presentation over to Jerry to start our discussion.
Thank you, Jason. Good afternoon, everybody. Thank you very much for joining us. So the first question, I think, is what is commercial paper? Historically, commercial paper has been a short-term debt security with a maturity typically of less than 9 months. Classically, commercial paper was issued under Section 3A3 of the 33 Act. But for a number of reasons that we'll get into, there also developed a 4A2 market in commercial paper. There were significant differences between the two markets for some time, but I think probably today the 4A2 market is more predominant, and pretty much today they price the same way. Next slide, please. You can see references, kind of fleeting references to commercial paper going back to revolutionary times, but certainly by the period shortly before the U.S. Civil War, commercial paper was pretty common, and in those times, commercial paper consisted of merchants and manufacturers selling receivables at a discount to investors in the money market. That is, people who were willing to buy short-term obligations. That transitioned to banks buying the short-term obligations rather than money market investors. And it transitioned again to corporations issuing short-term securities to fund the receivables on their own balance sheet. And commercial paper was a very significant part of the commercial activity of the nation. By the time we got to 1933, when Congress wanted to regulate the issuance of securities, commercial paper was an oddity. It didn't really fit the registration scheme that Congress was contemplating, where you had to file a registration statement, give the commission an opportunity to review the registration statement, give you comments back, and pay a registration fee for the issuance of securities. As a result, the U.S. Treasury pushed Congress for an exemption for commercial paper, and the result of that was Section 3A3. Next slide, please. If commercial paper was going to receive special treatment, it had to be defined narrowly. And when I say special treatment, securities issued under Section 3A3 are not subject to the registration requirements of Section 5. So to have that benefit, that commercial paper was narrowly defined. And you can see it here as any note, draft, bill of exchange, or banker's acceptance that arises out of a current transaction, or the proceeds of which are to be used for a current transaction, and with a maturity at the time of issuance not exceeding 9 months. Now, the SEC has issued numerous no action letters related to the interpretation of current transactions. I don't think they issue those letters anymore because there were so many issued. I think it pretty much covered the landscape. But most noteworthy, a current transaction, an acquisition or any kind of a capital investment, for example, for a plant, do not satisfy the requirement for a current transaction. Next page, please. Next slide, please. And then in 1961, the SEC issued a release setting forth their interpretation of what constituted commercial paper. And they state that the legislative history of the Securities Act makes clear that Section 3A3 applies only to prime quality negotiable commercial paper of a type not ordinarily purchased by the general public. That is, paper used to facilitate well-recognized types at current operational requirements and of a type eligible for discounting by the Federal Reserve banks. Just as a footnote, the Federal Reserve banks no longer discount commercial paper. The staff has also interpreted Section 3A3 as not being applicable to obligations that have any automatic rollover or automatic extension provisions. Next slide, please. So you see the SEC set forth basically 6 requirements for commercial paper. 3A3 commercial paper has to be negotiable, has to be prime quality. That's usually satisfied by having the rating agencies rate the paper. Has to be eligible for discount, no longer an applicable requirement. Not ordinarily purchased by the general public, and certainly not sold on a retail basis. Used to facilitate current transactions, and that's an interpretation, a definition that changes by the type of issuer. A current transaction for a bank is not the same as a current transaction for example, a public utility. And a maturity of 9 months or less with no automatic rollover. Next slide, please. The definition of current transaction really kind of lends itself to the concept of working capital. Commercial paper is used particularly by corporations for wages and salaries, for inventory, to fund accounts receivable, for all kinds of transactions that normally would be covered by working capital. Partly as a result of the restrictions on the use of 3A3 to fund acquisitions, corporations began issuing short-term commercial paper under Section 4A2 to fund acquisitions. There's no definitions under Section 4A2 for commercial paper. 4A2 applies to any privately placed security with any with any maturity. That meant that 4A2 commercial paper was not subject to the 9-month limitation of 3A3 commercial paper. And for a while, 4A2 commercial paper suffered a little bit in pricing by being a restricted security, but by 1990, this difference has largely disappeared. And maybe Stuart can touch on that later from a market perspective. With that, let me turn it over to Ian Rasmussen to talk briefly about ABCP.
Thanks, Jerry. Yeah, what I wanted to do is spend a little bit of time talking specifically about ABCP, what it is, and then essentially transition our discussion into the types of ABCP that we're seeing, and then we'll have an opportunity to talk about some of the newer forms as we proceed in the discussion. If you could turn to the next slide, Hanson, that would be helpful. All right, so what is ABCP? Well, just as Jerry mentioned to us at the beginning, with everything old being new again, essentially ABCP conduits are set up. They're bankruptcy remote, limited purpose finance companies to finance traditional assets, either through a traditional asset purchase or through a secured loan. The underlying transactions that are entered into by ABC conduits often represent an undivided interest in the revolving pools. So these are generally kind of warehouse-oriented transactions, which have a revolving pool of assets set by eligibility criteria with a particular seller in mind. They revolve over time. And in most cases, the assets are providing the security to the CP. And in the chart you can see here, what I have is the kind of the overall distribution of what the underlying assets are in our multi-seller ABCP conduits. So you can see that they're generally fairly traditional assets, consumer or commercial assets that have been involved in securitization for a long time. We see with ABCP conduits that the administrators have very defined credit policies and investment policies. And so over the last few years, we really haven't seen a significant change in the underlying assets or transactions that each conduit is purchasing. Those are generally in line with a long-term investment strategy for that particular manager and a particular conduit. Unlike term securitizations, the ABCP conduit doesn't wind down after a few years. And so one of the important features is not only are we focused on the administration of the underlying asset or transactions, which have very similar support or operational support as a term ABS securitization, servicer, originator, but you also have an additional kind of operational complexity here, because the conduit is going to be issuing CP on an ongoing basis with various kind of laddered maturities, and they're going to be needing to manage that liability structure over time. One of an important development for investors in ABCP since the financial crisis is that generally the market's moved to more of a fully supported conduit structure. After the global financial crisis, there are still some conduits that have exposure, the CP has exposure to the performance, the credit performance of the underlying assets. But in most cases, the liquidity agreement that is protective of the ability to pay off CP if there's difficulties in the market, those have been expanded to also include losses on the underlying asset portfolio. And I'll talk just a little bit in just a minute about the distinction between partially and fully supported transactions. In that kind of development of the structure following the global financial crisis, we've seen just overall very strong levels of stability and consistency in the management, the outstandings of ABCP since that time. One thing that I do want to mention is that there has been no return to the short-term financing vehicles that came into being before the global financial crisis, namely SIVs, structured investment vehicles, which had a market risk component to them. Similar kind of funding strategies, except for there was a need to sell or liquidate assets in order to pay off all outstanding notes or CP. And in that case, the lack of liquidity during the global financial crisis provided challenges not only to sell assets, but also to issue additional securities to roll the liability structure. So we haven't seen any return to that. We in the ABCP conduits, Fitch rates, we have no market value risk. So let's talk a little bit about the types of ABCP. If you want to go to the next slide. So what I've provided here is just a high-level structural diagram of a common traditional multi-seller asset-backed commercial paper program. What I wanted to point out in the diagram is, first of all, you have the sellers and originators, which can be multiple or a single seller into the conduit. In this case, there are multiple sellers originators. They're getting financing from the conduit to extend additional loans, whatever those loans may be, through the issuance of the CP. The other important parts to consider are the various other operational roles that are filled for the conduit, such as the manager and administrative agent. I talked about the importance of that given the ongoing kind of life of a conduit, and the issue and paying agent, which we expect to see as having high credit quality, similar to the rating that we're assigning to the asset-backed commercial paper itself. Now, the types of ABCP is multi-seller, which is here. It's that's easy to understand in that it's just multiple sellers selling into the conduit, receiving financing. A single seller conduit is one generally that's set up by a particular bank or conduit to finance their specific business. So it's just one seller receiving funding from the conduit. Now, the new types of programs, which we'll talk a little bit more in a bit, are what we are calling match-funded programs, where the issuance of ABCP is backed by a particular financing agreement in which the terms of the CP and the terms of the underlying agreement are matched to build liquidity in to the trade organically. So those are the three kind of major types of programs. I would say match funded is an example of that, or some of the newer third-party managed programs and collateralized CP programs. And then, so that's more from the establishment of the structure. We also look at ABCP programs in the way that they're supported. We have fully supported programs and partially supported programs. It's important to remember that because of the inherent liquidity mismatch in an ABCP conduit, generally longer term assets with very short liabilities, there's an inherent liquidity issue. So in all cases, ABCP programs are set up with liquidity support so that there is there's committed liquidity to retire all outstanding ABCP. Where the additional fully or partially supported comes from is the credit support. So in fully supported programs, any losses on the underlying asset are actually covered either through the liquidity agreement or by some other mechanism. In partially supported programs, the performance of the underlying assets is important because any credit losses will reduce the commitment under the liquidity agreement. So there's no kind of need to provide liquidity for a defaulted asset. In that case, we're very much focused on the inherent liquidity in each transaction, and generally program-wide credit enhancement that's a fungible layer that's at the top of the conduit. And we'll get into a little bit more kind of the rating, the key rating factors that we use to evaluate each of those points in just a minute. Do you want to go to the next slide?
Stuart, maybe let me jump in just for a minute. Pardon me. I just want to point out to everybody that what I want to focus on here in the next couple of slides is the difference between the commercial market and the term market. There's some really sharp differences between the two, and it really affects practices in the market and the underlying legal excuse me legal considerations. Stuart, with that, I think I can turn it over to you.
Okay. Thank you, Jerry. Can you hear me okay?
Yes.
Okay, great. Well, thank you. And let me just say before I start, I'm very complimented to be asked to participate in this event. There are few counsels with the experience that Jerry brings to this market, and Mayor Brown has been a leader in the issues affecting CP for a very long time. So thank you for inviting me to participate. As you point out, the commercial paper market is significantly different from the term bond market for the loan market. It is, as this slide indicates, we are a continuously offered product, which means that we stand as dealers for a commercial paper program ready to issue on any day in any amount and for whatever maturity out to 1 year a customer desires. In the US, we settle on a same-day basis, meaning that if we issue paper this morning, we will settle at 3 o'clock this afternoon. And our investor base is not the general public. It is institutional investors. I'll talk a little bit more about those specific in a minute. We are not an SEC registered product. Jerry mentioned some of the exemptions to registration, the 4A2 and the 3A3, and there are others, but those are the principal ones. The point being that commercial paper is exempt from any SEC registration. In order to sort of verify or justify the institutional nature of this product, the minimum denominations are typically a minimum of 200,000, although the typical trade in commercial paper is in the millions. While we do trades of 5 to 10 million on a given day, we also do trades of 500 or larger on a regular course of business. 3A3 offering is considered a public offering in that it can be offered in a general solicitation, but as I said, the institutional buyers for this product, given its size and nature, are typically not any sort of mom and pop investor. It is typically an institutional account buying in many millions per trade. In our market, we do roll commercial paper. So as we say, these are short-term debt liabilities that extend anywhere from overnight out to 1 year. And a typical practice in the market is that at maturity, those notes are paid, or the maturing notes are paid from the proceeds of a reissuance of those notes. A very high percentage of the market is overnight to 2 weeks, and a great deal of our activity is in short maturities, as many of the corporate and asset-backed issuers are looking for short tenors. Having said that, we do have, especially in the bank community, demand both as an issuer and for investors in the all the way out to 1 year. On a daily basis, when we receive instructions for issuance of commercial paper from an issuer, whether a corporate, a bank, or an ABCP program, that is a very mechanical and standard procedure every day. No counsel is involved in the actual issuance. It's strictly a matter between the issuer and the dealer trading desk and the investor for the execution of a trade. And that's quite different from a bond market where you might have extensive documentation and opinions that are refreshed on the issuance. Typically in the CP market, all that documentation is presented or prepared up front, and the program, once rated and active, has the ability to continue to offer on a continuous basis. Let me throw out a few characteristics if I could, and maybe we turn to the next slide. Some of the capacity in the market. Let me just give some characteristics about the market overall, and get to the sort of outstanding. So the US CP market, which is the primary focus of this discussion, is about 1.2 trillion in terms of total outstandings. And the Euro commercial paper market, which provides for the issuance of euro, sterling, and dollar CP, is about 500 to 600 billion in total outstandings. The typical issuers in the market in the US primarily corporates representing between 20 and 25% of total outstandings, banks who use the CP market as an alternative deposit gathering network, and ABCP programs, which Ian was referencing a moment ago, again, about 25% of total outstandings. In the ECP market, SSA or government guaranteed issuers represent almost half of the market. Banks, a smaller proportion, because in Europe, many of the banks have their own deposit gathering capability. Corporates represent about 15% and ABCP about 10% of that market. As we've discussed, our issuances are typically overnight to 12 months. In the US, the typical trade is about 1 month, and in Europe, the typical trade would be a 3-month trade. On a daily basis, we do about 25 billion in ECP and about 125 billion in USCP. The investors in this market would typically include money market funds, both in US and Europe, corporations who are using CP as an alternative investment to a bank deposit for their excess cash, states and municipalities. These are governments who take their tax receipts and federal stimulus money and other collections pending their payment out for projects or improvements or other cash requirements. Insurance companies, both casualty and life, who liquidity balances for claims against insurance, invest those short-term cash reserves in commercial paper. And then banks, regional, local, other banks use commercial paper as a investment vehicle for excess deposits that they have received. As I mentioned, these programs on a mechanical basis, once established, are perennial. They provide for continuous offering, and we stand ready as a dealer to issue on any given day for settlement in the US on the same day, or in Europe, typically 2 days forward. In terms of some of the trends that we would highlight, we are certainly in a rising rate environment with Fed hikes, which no doubt everyone on the call is well familiar with, both in US and in Europe. However, we are enjoying a period of extremely strong liquidity. Assets under management by each of the investor types I mentioned are on an increasing trend, favorably influenced, frankly, by higher yields to the investors than we have had over the course of the last years. And CP outstandings growth following the COVID experience, more corporates feeling confident about dependability of liquidity in commercial paper market, and low cost relative to term issuance. Banks have been very active recently in issuing floating rate commercial paper and CDs. The reason being, many investors don't want to take the risk of higher than expected Fed hikes and prefer to buy floating rate securities, which adjust in terms of yield as soon as Federal Open Market Committee votes on incremental hikes. And so maybe I'll pause there. Jerry, I think I've touched on most of the key characteristics, but turn it back to you.
Thank you, Stuart. So let me just jump in, Ian, before you get to ratings. There are a couple of points I wanted to emphasize here. One is the same day settlement on commercial paper, which is obviously unusual. The term market today is for registered term debt 2 days. More typically in a 144A market, it's T+5. But commercial paper has been same day settlement for as long as I can remember. And that imposes a couple of restraints on issuers. We'll get to it a little bit later, but it's the same day settlement that really generates a heightened liquidity requirement for CP issuers. As both Ian and Stuart said, it's typical to use the issuance from newly issued commercial paper to pay off maturing notes. So the issuer's expectation is when they have notes maturing today that they can call up the CP desk and issue new commercial paper and use the proceeds to pay off notes. If for some reason there's a market disruption and you can't sell commercial paper notes, you're not going to know that probably until late in the day, maybe 11 o'clock, maybe 11:30. Then you've got to turn around and find liquidity to pay off those maturing commercial paper notes. And that liquidity capacity is critical to rating commercial paper. Commercial paper desk. I sat on a desk at JP Morgan once about 15 years ago and watched it operate. It's a fascinating process. As Stuart said, there's roughly $120 billion of commercial paper every day that goes through commercial paper desks across the industry. $120 billion is a month's worth of production in the term market. So they're doing a month's worth of work on a single day. Issuers call up the commercial paper desk or do it by these days by links and negotiate with the desk on how much they want to sell, for what maturities, for what discount or what maturity rates. And the dealer, who has no opportunity to market that paper, makes a decision to buy it on the spot. And when I was sitting on the desk that day, at one point, the dealer had $18 billion of commercial paper in his portfolio that hadn't sold yet. It was getting late in the morning and people were getting nervous. So the operation of the desk and the purchase of commercial paper and the marketing on the other side after investors is a very different process from what you see in the term market. With that, maybe we can just flip through a few, the next slide. Next slide. Good, next slide. So I want to focus on CP outstanding, and Stuart touched on it. You can see here, November 23rd, we had just about $1.25 trillion worth of commercial paper outstanding. And you can see in the bottom slide, the distribution of tenors. So in the 1 to 4 day and the 5 to 9 day period, there's something between 80% and 90% of the entire market is in that maturity band. So that means that the average outstanding commercial paper has something less than a 10-day maturity. With a $1.2 trillion market, an average of 10-day maturity means every day you're rolling 10% of the market. So it's a very, very active market. Next slide, please. Just a little comment on the differences between like asset-backed commercial paper and AA financial commercial paper. The distribution of maturities is quite different. Next slide, please. These are Stuart's two slides, and maybe Stuart, I'll let you talk about them. But this is outstanding commercial paper in the U.S. market and in the EU market.
Yes, exactly, Jerry. So this slide just gives some historical color as to the outstandings in our market. Total outstandings, as I said, are about 1.2 trillion today. After COVID, where there was a great concern about the bottom falling out of the economy, and you saw a dramatic reduction of liquidity in the market overall. Many issuers paid down commercial paper, borrowed under their bank line, or issued term debt. As people realized that the market and the world were not coming to an end, we returned to the CP market, and we saw outstandings grow beginning in the third quarter of 2020. And although rates do typically fluctuate outstandings do tend to fluctuate over time. As I say, we're on a fairly regular growth pattern really since this time last year. In this slide, I've segregated the non-financial, which is generally corporates, from the banks, which are in light teal, and the ABCP outstandings, which are in tan. The ABCP market has been extremely stable at around 250 to 275 billion. The bank sector is much more volatile, and some of this is affected by the fact that banks have alternative sources of funds to CP. That includes issuance of CDs and, of course, repo and other types of funding. The non-financial or corporate sector is broken down between tier 1 and tier 2. Tier 1 represents any investor or issuer who is A1, P1 or better, and those who are tier 2 would be A2, P2 and below. In our market, about of the total A2, P2 market, current outstanding is about 125 billion, and tier 1 outstandings sort of on the 180 to 200 billion in outstandings. And but all of those investors, whether non-financial, financial, or ABCP, investment grade rated, meaning greater than A3, P3. Next slide. Okay, this is the same slide just for ECP. As I mentioned, the SSA sector, which are government guaranteed issuers like KfW and BNG and others, sovereigns as well, have been dominant players in the market. Banks in the teal color, not so active because they obviously have their own deposit gathering networks. Corporates, which in the Euro market have largely relied on bank funding, i.e. going to banks for term loans and revolvers, have not been as active, but that sector has been growing, especially receptive to U.S. issuers in the corporate sector. And the asset-backed CP area also in the tan color down there at the bottom, about 50 billion in total outstandings. Outstandings in this market have run off rather abruptly over the course of this year, primarily reflecting reduced borrowing activity by SSA issuers who've done a lot more funding in the bond market this year and less in CP overall. I'll pause there, Jerry.
Yeah, just one comment on that, Stuart. I think you told me that in the U.S. market, in the financial sector, that about 60% of that is represented by foreign banks and not by domestic banks. Is that right?
Yes, that's correct. And the reason is that many of the domestic banks, like domestic U.S. banks, have deposit gathering networks which bring in all the U.S. dollar denominated funding that they need generally. It's foreign banks who have significant banking and investment banking operations in the U.S. that need dollar funding. They don't have local deposit gathering capability and therefore rely on commercial paper as a source of short-term dollar funding.
Good. Next slide, please. Next slide. Well, back up for a moment. Sorry. I think, Stuart, you touched on these, that the investors in the commercial paper market are corporate treasuries, municipalities, short-term bond funds, banks, money market funds, everybody kind of with an excess of funds. And typically, particularly with corporate treasuries, they want to invest those funds on a very short-term basis. So that's a fairly good match for the short-term issuance. Next slide, please. Stuart has touched on these, except for, you indicated, Stuart, that commercial papers, this is a discount or at a fixed rate or at a floating rate. There's also puttable, callable, extendable commercial paper. It's become more common for bank issuances in particular, and it's driven by liquidity coverage ratio, which we'll talk about a little bit in the developments. Next slide, please. So with this, I'll turn it back to Ian to talk about ratings, the rating process, and some recent changes to the rating criteria.
Yeah, so for many of the reasons, Jerry, you mentioned earlier, investors use the ratings assigned to CP as an understanding of credit risk, similar to the way that they use ratings as an input in their investment process and in kind of other sectors. For CP broadly, Fitch assigns short-term ratings, and we generally have the ability to assign short-term ratings when the tenor of an instrument is below 397 days. We assign short-term ratings to commercial paper. We have a short-term rating credit methodology that's applied to both financial institutions, including non-bank financial institutions and corporates. That methodology has resulted in us being a bit more kind of flexible or wider in the mapping between a long-term rating and a short-term rating across banks and corporates, really with the idea that those entities need to be reviewed for their liquidity position to be able to have an adequate view of their short-term rating. And so we did see a couple of years ago when this was instituted some upgrades in corporates and banks as a result of the new criteria. In addition, we changed the kind of rating linkage in the ABCP criteria last year. This is more impactful in EMEA, but essentially what we're looking to do is link to the short-term senior debt preferred rating we're assigned for a bank, as opposed to using just the short-term IDR. The reason for that is we believe that this preferred debt rating is a better approximation of the credit risk for more senior obligations, such as those that a bank is offering a commercial paper conduit. For ABCP specifically, and we've touched on most of these risk concerns already in the conversation, but the three main risk factors are liquidity risk, credit risk, and program management, and the ability of a program administrator to manage the program over time. And I think we've done a good job of covering the reason for each of those. I do want to state, I kind of touched on liquidity earlier. For most ABCP conduits, there is a committed liquidity that is either generally in the form of an asset purchase agreement or a loan agreement. And that's done on a committed basis so that we know that the liquidity is available in there if there's an inability to roll. However, we do assign ratings to conduits that don't have a committed facility to provide liquidity. In those cases, as I mentioned before, it's more of a match funded type program where each transaction is aligned with the outstanding CP. And where we're very focused there is making sure that the structure and the provisions of the structure combined with program management will allow for there to be appropriate cash flow and liquidity to pay the outstanding CP when due. For credit, I already touched on partial support and full support. We're certainly much more focused on the credit quality of the assets in a partially supported program. We review each underlying transaction in conjunction with a review of program level or program-wide credit enhancement. So if we see, for instance, a particular transaction has an advance rate or an attachment point that is lower than kind of our expectations at that particular rating level, we may look to program-wide credit enhancement as a fungible layer of credit protection in those circumstances. I do want to point out as well that it's very common in partially supported conduits to have some transactions that are fully supported. So it's up to generally the kind of the credit decisioning of the administrator on which assets will be fully supported, therefore no losses will impact the ABCP conduit, or those that will not be supported through the liquidity agreements. Hi, Jerry, I think you're on mute.
Thank you. Sorry. I was saying I wanted to ask you one question I haven't shared with you before, so it's a little bit unfair. But how do you evaluate the liquidity capacity of a corporate commercial paper issuer?
There is a scorecard that we use in each sectors. And so for corporate or bank issuers, We have, if you take a look at our criteria, we have a scorecard which goes through the liquidity position, available cash, et cetera, to essentially score and rank that liquidity position, which then is used to evaluate the short-term risk of that entity compared to its long-term rating. If there's a strong liquidity position, it's likely that the short-term rating will be at the upper bounds of the long-term to short-term mapping.
Good. So let's flip to the next slide. And I just want to touch here on, again, how important liquidity is for commercial paper. And the reason is that the second bullet point there, with commercial paper, there are no grace periods. Unlike term debt, which often has a 5-day grace period, there's no grace period for commercial paper. If you don't pay it on time, you're in default. And that's why access to liquidity, either through bank lines or through available cash, is and on a very short-term notice, possibly as short as a couple of hours, is critical to the commercial paper market. If there's a market-wide disruption, the draws on bank lines of credit can be very substantial. If we're rolling over roughly 10% of the market every day, that's a significant draw on banks, not to be forgotten. Next slide, please. So we're going to talk for a few minutes here about regulatory developments, and some of which I'm going to ask Stuart and Ian to jump in on. The first one, and perhaps the most impactful one on the commercial paper market, has been the changes in the regulation of money market funds. Before the financial crisis, money market funds were purchasing somewhere in the neighborhood of 50 or 60% of the entire outstandings in the commercial paper market, and they were particularly important investors in the asset-backed commercial paper market. In the crisis, the government had to provide liquidity facilities for money market funds to prevent a run on the funds. And in response to that, in 2014, the SEC adopted new rules for money market funds and imposed gates and fees with the intention of reducing the impact of a run on money market funds. So to reduce the amount of that could be withdrawn from a fund on any day. In the pandemic, we saw the possible runs on funds again, and it turned out that the gates and fees were not very effective because they simply incentivized people to move more quickly to try to withdraw money from funds. So in reaction to that, last year, the SEC introduced some new proposals. They introduced, which had not been adopted yet, but those would impose swing pricing, and they would increase the liquidity requirement for money market funds. And that's the most important thing I want to touch on here. Previously, money market funds had to maintain on a daily basis 10% of their total assets in daily liquidity requirements. That is in either cash or U.S. government securities or securities that were maturing on that day, and 30% of total assets in weekly liquidity requirements. The proposals would boost that to 25% and 50%. And you can see the impact of this on the commercial paper market is going to be quite extensive. Money market funds currently fund about 10% of asset-backed commercial paper, 15%. It's expected, if these proposals go through, that there will be a further reduction in the capacity of money market funds to fund asset-backed commercial paper. There's some institutional fund investors stepping in as an alternative to money market funds. Short duration ETFs, private funds as an alternative, particularly where investors want to see more of a return than they can get out of a money market fund. Some investment advisors can set up private funds for the investor that can buy longer term paper. Next slide. Oh, Stuart, maybe you could just jump in and with a comment. Have you seen an impact of this in the market?
Yeah, Jerry. So in terms of whether these proposals actually come to pass, we are waiting for the SEC to actually present them as new rules. It was expected that these would be announced by the end of the year. Actually, sometime earlier this quarter that they were expected originally, but hopefully by the end of the year. They will probably, if they come into effect, there will be some period of delay before they become effective, although we would expect that the gates and fees provisions of the 2016 reforms would be immediately relieved or removed, but the increased liquidity requirements and would likely come into effect sometime later in 2023, and swing pricing probably even later than that. I would also mention, though, that the money market fund in the past had originally just been such a flexible and dynamic product that was very attractive to all investors. Obviously, in terms of market stress, maybe need for additional controls and regulation were suggested, and the government support was necessary in 2008 and even in 2020. But we would anticipate that even if money funds become a less attractive investment vehicle because of these requirements and because of the impact that it would likely have on yield, that the money fund managers are very likely to retain those funds under management, either, as you point out, in the case of short duration bond funds or separately managed accounts or private funds that are not technically a 2A7 money fund, so that those large investment managers who principal sponsors of money market funds will likely continue to have the substantial buying power for commercial paper, but it may not be into the money market fund. It will be into some of these alternative money short-term investment products.
Yeah. And Jerry, from my perspective, maybe just another thing to highlight is we have this long-term kind of regulatory impact on the short-term markets, which is divergent. So you have the issuers wanting to issue no shorter than 30 days because of the regulatory guidelines, LCR requirements. And then you have, from the investor side, regulatory developments that are trying to shorten and provide much higher amounts of liquidity. I think that that's just a tension that's going to remain. I agree with Stuart. We certainly did see the private funds, the ultra short bond funds come into the market after the first money fund reform. I would say overall, the kind of asset growth in those fund products hasn't fully replaced institutional prime. So there will continue to be a dislocation, but I think from my perspective, ABCP conduits have done a good job of expanding their investor base and aren't as dependent upon money market funds specifically to purchase their paper.
Thanks, Ian. Next slide, please. So you'll see that Ian just touched on the first paragraph here, which is the liquidity coverage ratio and exactly the tension between banks wanting to issue longer term paper and money market funds wanting to buy shorter term paper. And that's a tension that's unlikely to go away. I'm going to move a little quickly here because we're running out of time. The Volcker rule is a rule that impacts particularly asset-backed commercial paper. Certain exemptions that under the Investment Company Act, if they're used by the issuer, mean that banks cannot invest in the commercial paper. Certain changes to the accounting rules have made it harder to obtain off-balance sheet structures. So what used to be some very common structures are not done as often. I'm thinking in particular about credit card offerings, for example, where many banks are just keeping their credit card balances on balance sheet. And the Jobs Act, which initially was adopted in 2012, led to no further use of Rule 506 because of the bad actor disqualification requirements under the rule. But the Jobs Act changes did have one beneficial effect, which is under Rule 144A. So long as securities are sold only to QIBs, they can be offered to anybody. It does not constitute a public offering if sales are made only to QIBs. Next slide, please. And I'll talk quickly here.
That's qualified institutional buyers.
Thank you, sir. Rule 15C211. So Rule 15C211 is what's commonly referred to as the penny stock rule. It was adopted by the SEC in the early 70s, and it was really directed at a practice in the over-the-counter market of forming shell corporations and making how would I put it, a pump and dump activity where between the practitioners in this market, they would sell securities back and forth to each other and drive up the price of the securities. And to make it really work, they were dependent on broker dealers publishing quotes in the securities in order to get the information out to the public. The SEC adopted some rules in the 1970s that tried to restrain this problem, and it required broker dealers to have information on hand about the issuer before they could publish quotes about the issuer, and particularly some information about the financial statements of the issuer. For many, many years, it was never thought that 15C211 applied to the fixed income market. But in a no action letter issued in 2020, the commission took the position that the rule in fact did apply. They granted no action relief in order to allow the broker dealers some time to comply with the rule. And it raised a lot of uncertainty in the market because there had been no commission consideration. It was a staff position. So there was no public deliberation about how the rule would be applied. There was no public comment period on that position, so there was no commentary back and forth on what the impact would be. And if broker dealers decreased their publication, the result would be, it's expected, there would be less issuance, because if bids weren't being published, it's harder to price a security, and the security is likely to be less liquid in the secondary market. There would be less investor interest, and there would be less broker-dealer revenue. And it also would constitute difficulties in the compliance area, because it would be difficult to value a portfolio that a trader was holding, and difficulties in the auditing area, because it's harder for the auditors to value a portfolio of these securities. Fortunately, November 30th, the commission issued a new no action letter, just extending the relief through 2025, which will be after Chairman Gensler has, perhaps after Chairman Gensler has left office, is after the next election. With that, let's turn very quickly to the last slide. Newly established commercial paper conduits. The only ones I want to touch on here probably is a TRS provider, where a commercial paper conduit can use the proceeds of a commercial paper offering to buy, for example, an equity security in the market, and then enter into a total return swap with perhaps a bank on the other side. Because the bank is the counterparty on the total return swap, and because it's match funded with the commercial paper, there's usually no external liquidity facility. Ian, maybe you just want to comment quickly on what you've seen in recent conduits.
Yeah, I mean, you're exactly right, and the kind of TRS financial contracts between a bank and conduit is something that we've seen. I would say overall, the new programs are being established with a bit of a different purpose. So like a traditional multi-seller ABCP program is established by a bank to provide funding and financing for their clients, the sellers of the assets into the portfolio. The new programs are generally being set up as balance sheet optimization vehicles for large financial institutions. And so where they have specific issues, the new third-party program managers are talking to banks about how they can provide solutions on their balance sheet and optimization.
And with that, I want to thank Stuart and Ian in particular for participating in this. And thank you everybody for joining.